Good morning, everyone. So this is our bi-monthly meeting connected with the MPC Monetary Policy Committee meeting that took place yesterday. You've already seen the press release as Wallace Kantai has just confirmed, and of course is available on our website. And I just wanted to do the usual, which is to cover the main points that the MPC considered, and without going through the press release itself. So a different approach to the same content. This was a rather unique Monetary Policy Committee meeting. And it is unique because of its conjuncture. The MPC met against a backdrop of the most favorable economic outlook in recent times. Of course, there are some identifiable risks, but what was clear is that we had to go way back to find another instant where you could say you had the same set of favorable conditions for the consideration of the meeting. Now, these were both external and internal. And on the external side, you also be aware while we were looking at some particular data, actually yesterday, the IMF released its update of global outlook. And that, and I quote, it shows brighter prospects and more optimistic markets, or optimism in the markets. The broadest synchronized global growth upsurge since 2010, end quote. So the global growth has really taken ground. And for 2018 and 2019, they have revised up their projection for global growth to 3.9% in each of those years. They've revised it up by 0.2 percentage points. That is significant. So that's the backdrop against which the external sector. Of course, there are also very strong global sentiments. There are also, of course, some risks related to, for instance, the price of oil and other such things. But I think it is clear that it has been a long time, in this case since 2010, and you could go back a little further if you really want to dig into history, since you had the same sense from the external sector. What about domestically? Domestically also, we had very favorable outlook. First, we begin with inflation. The inflation outlook, it's well anchored. I think you already know that the December inflation number was 4.5%. That's the 12-month growth to 12-month inflation number to December. And you have to go back actually to 2013 to have a similar number. Now, non-food, non-fuel inflation has also been well anchored. It's been well below, it has been below 5% since December 2016. So there are no concerns really about the sort of second round effects, or should we say demand pressures from any of these numbers. What about growth? The numbers you've already seen, growth in Q1 to Q3 of 2017, that is the first 3 quarters of 2017. The number there shows that the economy expanded by 4.7%. And I'll hasten to say agriculture expanded by 0.8%. 0.8% compared to, say, 5% in a comparable period in 2016. So you can see agriculture, which which contributes to 25% of our economy, is actually a drag on the rest of the economy. It's interesting, actually, that our projection for agriculture for the year 2017 is 2.4%. That's the number we have, right? The way we do it, you have the Q1, Q3 actual, and then you have Q4 estimate as to where you think will come out. And so you have a growth rate of agriculture in 2017, which we project to be 2.4%. Now, it's interesting that you have to go back to 2012 to have agriculture growing at that rate. The average over the last 4 years, that is if you exclude 2017, last 4 years, except 2017, is actually 5.4%. I'm talking growth of agriculture. And that has fallen to 2.4%. And to get a growth rate of 2.4% in agriculture, you have to go way back to 2012, when things were really dire in the agricultural sector. As a matter of fact, in that year, the overall growth rate of the economy was 4.6%. Okay, so you can see this as sort of like, let's say, not so robust growth. I mean, relative to the other numbers that we've seen before, but it's, anyway. I wanted to talk a little more about agriculture, to give you those numbers, just to show you that the economy, in some sense, has one drag, which is agriculture, and in 2017, and that we know where it came from. That was the drought that we had earlier in the year, and indeed also in the last quarter of 2016. In any event, it's interesting to ask the question, what about the other sectors? So we've talked about agriculture. What about industry? What about services? And industry in the first 3 quarters of 2017 grew by 4.3%. And that compares to a similar period in 2016 of 5.8. Of course, the sector that has really been vibrant was the services sector. And as we have said before, this was on the back of strong micro, small, and medium-sized enterprises. And the sectors there that were quite dynamic were the wholesale and retail trade, transport and storage, and real estate. The others, but those definitely, those three showed significant dynamism. That said, the 2017, the estimate, given all the things that we had, the drought, given the political uncertainties or noises that we had later in the year, given also other sentiments in terms of investor confidence and things like that, the outcome that we are estimating is somewhere around 5%. Around 5%. I don't want to be very precise because in a little while we are going to have a number, but if you really wanted to pin me down on this, I would say, well, okay, we did get 5, we did get 4.9 in the various estimates. Also, I'm told that the others that have come up with similar numbers. The point is it's around 4.95%, around there. This on the back of agriculture performing so dismally. So even with agriculture only moving at 2.4%. So what are we talking about here? We are talking about what I called last time extraordinary resilience of the Kenyan economy. And I think this is one of the elements that I wanted to flag in terms of showing in terms of underscoring the domestic vibrance that we are seeing. There is a second element, of course, which is we saw very strong positive sentiments. Very strong positive sentiments. the MPC market perception survey that we do every 2 months, the last time we talked about the optimism in the economy, right? Optimism. So respondents, last time, which was November of 2017, right after the October elections and so forth, the general number that we had there was about 2/3, so 67% or so, of the respondents were optimistic about the prospects of the economy going forward in 2018. Actually, that number is up in the 90+%. So for banks, or you could say it's more than 90%. If you want to really drill down, just banks actually, 95% of respondents showed optimism on prospects for 2018. And non-banks, 90% of them were optimistic about prospects of 2018. At the same time, we have had very strong investor confidence. We were talking, DG and I were talking to some representatives of, let's say, diplomatic corps, and I just quote the words of one of these diplomats from, let's just say, a G3 country or G7 country, whatever that means, right? So a large country, right? And this diplomat said, and I quote, "They are seeing unprecedented interest from their investors in Kenya. Unprecedented interest from their countries in Kenya," end quote. So this is the backdrop. You can already see that it is, as I said at the beginning, is the most favorable economic outlook that we have seen in recent times. I'm not finished. I have a few more things to put out to you. What about the BOP, the balance of payments? What's happening there? And I think as a baseline, we are looking at a current account deficit in 2017 of 6.2%. So current account deficit of 6.2%, which is the same number that I talked about 2 months ago when we met. Actually, I was going to tell you the November number, but I think that's for later. Let me skip that. But I think the point here is it's elevated, as I explained last time, compared to, say, the current account deficit in 2016, mainly because of food imports related to the drought, and also fuel imports, meaning the increase in the price of oil. That has an impact here. And we are projecting a current account deficit we expect it to narrow in 2018 to 5.4% of GDP. On the back of exports, horticultures and others, tourism and other exports, but I think also other considerations such as very favorable, or should we say, remittances also. We discussed this last time, so maybe I'll be a bit, I'll skip it a little more. So, the foreign exchange market also has been very balanced, has remained balanced, and is expected to remain balanced on the back of this favorable current account position that I mentioned. There was, of course, the reserve number as well that you know. It was quoted. It was somewhere in the order of 7,009. And yes, and that is adequate reserves, as was explained in the press release. So what's the bottom line here? The bottom line here is that we have very favorable outlook with risks, yes, with risks, but risks that can be managed. The point then, the question I ask you is, okay, so we have what we'd call a confluence of positive factors. I've talked about the external and domestic positive factors. So the question I pose is, what do you need? What do we need to get a perfect storm? So a perfect storm in my jargon is having three factors that are working in the same dimension, right? In the same direction. So if you have three, you'll have a perfect storm, and then you'll have whatever. Now I know I didn't come up with a better analogy. Storm is a negative connotation, but I think we can all understand that, right? Positively. So what do we need to get a perfect storm? The external factors are very favorable. So you have what you may call tailwinds from there. Domestically, you also have very favorable factors working in your favor. What do you need? What's the third factor to make this, to work together and create what I would call the conditions of a perfect storm? Without a doubt, what you need is positive, or should we say supportive policies. That's what you need. If we had supportive policies going forward in 2018, we'll have a perfect storm. The tailwinds will carry us forward, and you could say that the policies will in effect create leverage or some dynamism which will buoy the economy forward. If you remember, I didn't mention this, but on a baseline sort of way, baseline meaning without any policy action, we are projecting growth for 2018 in the order of 6.2, right? 6.2%. So it is favorable in terms of looking at recent past. But this actually, I have to tell you, is a baseline, meaning it does not include significant positive factors that we expect, that could be expected to work or to be deployed in 2018. Let me explain. For instance, when we talked about the exports, and I talked about the current account of 5.4 in 2018, we did not project in there substantial growth in exports as one could expect arising from the SGR. Now, I know the English there is a bit tight, but I think you understand what I'm saying. The SGR has led to a substantial decrease in cost, transportation costs. We talked about that. And if actually if private sector utilize that, for instance, exporting avocados. Now, I know there's an issue about exporting avocados, but that's another matter. I like avocados, yes, I know. So the issue for us is, if you are thinking of horticultural exports, they could actually be exported via the SGR, and then by sea. And the cost of that will be 1/7, as I said, 1/7 of the cost of exporting horticulture products as we do today, by air and other means. So the point is, in our projections, we did not incorporate much of that. You also have another factor, for instance, or other dimension. I'm now giving you examples of how one could think of a more aggressive or more favorable, more active scenario that was not considered by the MPC. And the other one, of course, is, the impact of the, let's say, the direct flights to the US, which will be happening from October, late October, towards the end of October. And you can see this as pushing up tourism, meaning arrivals from the US. You can also see it pushing up exports, flower exports, my favorite example. So all those were not really fully incorporated in the number that I talked about, the 6.2. So on the back of all that, if you have favorable policies, supportive policies as opposed to constraining policies, there will be a stronger impact in the economy, and this will be the perfect storm that I mentioned a moment ago. Now, what sort of policies are we talking about? I think the first of this is fiscal. Positive fiscal policies or supportive fiscal policies. This obviously relates to consolidation of the fiscal position in light, of course, of recent outcomes, both in deficit and also in the debt numbers. You know, the deficit that was the one that we are projecting for this year, 8.9, and that is given the costs that we have that we incurred, you know, over the last, including elections, including on security and so forth. And also, of course, debt levels. We are somewhere around 50% of GDP in terms of public debt to GDP, public and publicly guaranteed debt to GDP. And yes, obviously we want to bring those dynamics in a particular way. And also realignment of fiscal stance in line with the objective, or should we call it the Big Four plan, which the President announced a couple of months ago. Now, you may have seen the National Treasury put out a document on their website. It's available to you, and it actually begins to make this journey in terms of fiscal consolidation. And in a sense, it is they are projecting a decline in the deficit in the next fiscal year. That is the year that begins in July, and then a continuation of declines to 3%. I believe 3 fiscal years down the road. So that's obviously something that would be positive, and a set of policies. Obviously, underlying that is a whole set of policies, but this would be supportive of and generate this perfect storm, or drive the economy to the perfect storm that I mentioned a moment ago. Another area, of course, another set of policies relates to the so-called interest rate caps. So far, the interest rate caps have been acting as a brake to the economy. I don't know if any of you have ever driven around with your brake still on, your car and your brake is on. Eventually something breaks. Yeah, it's not advisable to do that. So in that sense, you could say that the economy is being held back by this. And that is another set of issues, another set of factors that we will, as I mentioned before, we'll need to bring to the fore and deal with, so as to support rather than inhibit economic dynamism in the economy. Another set of issues, set of policies, relate to a further strengthening of the banking sector. This we've already started. I talked about the new normal some time ago. And we've also had significant development here. It's true the economy, the banking sector remains resilient, strong, but we are not satisfied as to where we are. We know our objective, and we have some ways to go, and we are bringing the banks along with that. We've talked before about reforms that would, for instance, lower the cost of credit. We've talked about specific things that banks need to do. We've talked about, for instance, credit information sharing, risk-based pricing of loans, transparency of lending, shareholders needing to accept lower returns. There's a whole slew of items that need to be deployed, or rather to be to come to effect. The last item I want to say, or the last set of policies, I have a list of 4. So first was fiscal, then interest rate caps, then strengthening of banking sector. The fourth is further progress in doing business, meaning improving the business environment. And this is obviously far-reaching. and it is at all levels. But I think the point here is that we cannot be satisfied by the recent, let's say, favorable improvement in ranking of Kenya in the World Bank's Doing Business report. It's not an issue of where we fall, in terms of ranking. It's an issue of how are businesses affected, and in a sense, we need to improve that. That is essential in particular ways. So I think these are the policies that we flag, and if these policies are supportive as opposed to constraining, given the very favorable domestic outlook, economic outlook, given the very favorable external outlook, we'll then have a strong confluence of these positive factors and thereby generate this perfect storm, right? I want to say a few things about the decision, therefore, as you read in the press release. Actually, there was a kind of a curious paragraph. If you looked at it, it was the second last paragraph, and I think this is where maybe just because everybody goes to the last paragraph, then maybe you miss the second last paragraph. I don't know what happens in the third last paragraph, So I always thought that you should begin at the top and read down, but I learned it's better to begin at the bottom and read up, So, but in any event, it's interesting. That paragraph is interesting because it's the first time we've had that paragraph. The MPC members did say that there is scope for accommodative monetary policies in the near term. I would actually ask you to go dig through our press releases and see when's the last time we said that. I don't know where it is. Maybe we have to ask Professor Terry Ryan to tell us, but I don't think we've ever done it. But we can put that out there. Anyway, the point is that there is scope for accommodative monetary policies in the near term. And in fact, the MPC members, so you could think, for instance, about in the old-fashioned way, if you are talking accommodative monetary policy or easing, monetary easing in a sense, the standard approach there, of course, is to lower rates, right? So we would have lowered the CBR rate, which signals a reduction of all other rates and so forth. But then very quickly they say that they see the risk of perverse outcomes. This we've talked about before. So we've made the point that in a sense, we are unsure whether really, if in order to accommodate policy, we should raise or lower the CBR rate, or lower the policy rate. So that is the issue that the MPC members were groping with, or were dealing with. And in effect, this is their forward guidance to the market. And the point here is that they did say that they want to monitor and assess the impact of its policy actions, meaning assess and monitor what happens if you lower rates. Does that actually have the same, does it work in the same direction, or are we having a perverse sort of direction, perverse effect? But they are signaling to the market, i.e. giving forward guidance, telegraphing, if you may, that yes, there is scope, and they see room for monetary easing, or rather, a more accommodative stance of monetary policy in the near term. And the objective here is to help guide the actions of the market, of market actors, and thereby enhance the policy that the MPC would actually put in place in the future. So in a sense, it is forward guidance, not just to say, but to actually to enhance the effectiveness of the outcome. So to give it even more surety as to the outcome that they want. At the end of the day, it's the outcome that is important. And that is really the purpose there. So there you have it, the first time that we've done forward guidance in our economy. So I want to finish, but cover a few other things, cover a few other things and then move on. Clearly, this is a point that this was an important meeting, and I think the MPC members gave us a lot more insight as to the state of the economy, and this is not a time to squander the available opportunity. It's a time to actually put in place those measures that are needed, meaning the policy actions that I mentioned before. Now, I guess there's been some questions before. Some of you have raised about debt sustainability and things like that. I've already answered that before, but just to mention it in passing. At this point, we do not see our debt level, public debt level, as being unsustainable. That is not the concern today. We also know why is it that we borrowed. A lot of the borrowing, or some of the borrowing, was for infrastructure investment and so forth, of which we do see as a large deficit. The issue is that room for borrowing, or rather debt for financing projects like that, is obviously narrowing because debt levels have risen. And the issue there is looking ahead, going forward, we need to have alternative means, alternative ways of financing those specific projects. I would tell you that the Deputy Governor and I had a very interesting conversation with some of the, this is the contractor and the engineer of the proposed Mombasa-Nairobi Expressway, Bechtel. And we also talked about their financing models and all that, and financing approaches. And I think that is a good example of what could be done. It isn't just one way of doing stuff, of financing. It's not just, there are many options. And I just want to say that the point there is to make sure that those financing, let's say, possibilities are well crafted to suit the appropriate project. There isn't one size fits all. Let's be clear. And also, of course, it is important that those projects are well assessed. So in terms of how expensive are they, meaning the cost, meaning the benefits to the economy, in terms of exports and in terms of anything else, all that, that there's a proper project appraisal for all these projects. That's all I want to say about that. On the other things, I think you've heard recently about the developments with regard to Imperial Bank. Last Friday, we got a ruling judicial ruling that actually froze all worldwide freezing of the assets of the shareholders. And this was something that has been going on for a year and some. And I think that is a remarkable step going forward in terms that we can get their assets wherever they are around the world. And we'll continue to go after them. We'll also continue to push on the other legal, should we say, judicial steps that need to be dealt with. Because at the end of the day, as we said, we want to we want to get as much of the depositors' funds as we can. We also want to assure all other shareholders to pay them as much as we can of their assets, or should we say liabilities of the institution. And also we want to strengthen the financial sector. So all those three, I think, this was a decision that actually strengthens us, or strengthens in all three dimensions. Also, in terms of Chase Bank, I think that's straightforward. We talked last time. We had a specific press conference on that. And as I said then, in a matter of weeks, we need to, we are operationalizing the transfers that I mentioned of depositors' accounts so that we can pay them in a matter of weeks. That's what I said when we met 10 days ago, whenever it was. And that is still on course. That is on course. I think I want to stop there. I think I've I think I've overextended my expectation, but thank you very much. Thank you very much. Your questions, please. In terms of going forward, I think the point here is that what we are doing now, we explained to the depositors what the intention was, what the plan was. And as I said, they were very appreciative and wanted to have this thing move ahead. What now we are doing is connecting the data in Chase Bank, and the data in SBM, right? So that information, let's say your name or you're of a depositor, or their information about their background IDs and all those other things, is populated in the account. So you open an account in SBM, and then you populate that information from information in Chase. You have to do that instead of asking all these depositors to come and open new accounts the way you would if you're going to a regular bank for the first time, kind of thing. So that's what we are doing. So what we are doing now is just connecting that. So making sure that that information is moving over. And again, our expectation is that can be done in a matter of weeks. And they've already started. So I cannot be more precise. I cannot be more precise in terms of the timing. I mean, I know I used the term in a matter of weeks 2 weeks ago when I met with the depositors, and I haven't changed on the timeline that we were thinking in that regard. The problem I have to tell you here is that it's not that I don't want to tell you anymore. I don't want to give you more information on that, but rather it's not predictable. You cannot sort of say it will take 3 weeks. It may take 2. It may take 4. But the point here is we are talking weeks. We are not talking months or any of those things. So we encourage their depositors to continue to be patient. They've been very patient for 2 years. So we think they can also be patient for a few more weeks. Then you asked about the government guaranteeing a policy that government guaranteeing lending, as you claim Barclays Bank seems to support. Wow. I see another question related to Barclays Bank from Victor. So maybe I'll call the Barclays Bank CEO after this. He planted some journalists, gave them questions. In terms of government guaranteeing of lending, the government has policies, and it executes on those policies based on the objectives that are there. And there are risks to all these policies, but I think it is the government to decide, based on its objectives, how to provide that sort of lending. I'm a bit surprised that Barclays would go there. I mean, there is a lot of work that they can do by themselves, right? I mean, Barclays is a bank that is all over the world. And to sort of begin by saying, oh, we want a government guarantee, is kind of let's say, it begs a question. Of course, if it happens, the government will do that, and there are some specific sectors that it may want to guarantee in particular ways. I think you remember, for instance, when we had a big problem in tourism, the hotel sector, when was it, 2 years ago? 2 years ago, 3 years ago? The government actually put in place, when the sector was decimated, you'd go into Mombasa and you'd see in the hotels there'll be one person, And indeed, the government did put forward a specific policy that supported them in particular ways. This is all part of government policy, well crafted and so forth. But I'm a bit surprised to see that as the one thing you remember from that presentation in Barclays. I would hope that there are many other ways. The whole point about, you should ask them about risk-based lending. Ask them about that. How are they doing that? I mean, why shouldn't they lend? Why shouldn't they improve their risk-based lending and provide correct pricing to everyone based on their risk, their calculated risk? I think that's the way to deal with that. So I hope I've given you some direction without necessarily opposing things. Infrastructure bond. Every infrastructure bond has a list of projects. It always has a list of projects, and that is public. It's on our website. It's also on the various other websites that are there. So, Mombi, just go onto our website or go to the relevant website and you'll see the entire list of projects. It's part of the requirement. That is a prospectus, if you may, of how the money will be used and how it will be, how the money will be used. George was asking something about the cuts of rates and things. You see, I did not say cut in rates. I said accommodative monetary policy, and it was by design. In a regular way, when we know how everything is going, I would have said cut in rates, right? But again, as I said, we have there is this potential for a perverse reaction to a cut. And I don't know whether cutting will actually lead to a tightening of monetary conditions. You understand? Because of this interest rate, the impact of the interest rate cuts. So that's why we cannot say cuts. In a regular sort of, when everything is working correctly, we could have told you that, cuts will do X. Or cuts will actually be, accommodative monetary policy, okay, you could do that by lowering rates, the policy rates and all that. So that's exactly why we did not make that statement. I hope you understand what I'm getting at. So yes, we are very careful with wording, very careful with wording. Now, the same thing, the break interest rate that you're talking about, that you asked. The point here is, I think the central bank's position is well known. That is not the question. The question is not where central bank is on this. The issue for us is we need to bring the rest of the population with us. And the point here is we need to work with stakeholders, including yourselves, to understand the impact of this. We already promised you a paper. I still continue to promise you a paper. Now it won't be a matter of weeks. It will be something else. I don't know what that is. So, again, very careful with wording. But we hope to provide you with this paper as soon as possible so that you can actually begin to, let's say, understand how the impact, or should we say, how damaging the caps have been, and whether or not they've achieved the objectives as was as happened in terms of the discussion that was there before. So, but I think the point here is that it's not just a business of the central bank in a sense. It is important for the population to come with us. The central bank is very clear where it is. And I think most people understand how these things are working. But we need to begin that. So we are on that journey. We are already on that journey. Victor had questions about the freezing of the assets and so forth of IBL and the depositors class suits. Well, there are those sort of things, but I really think, I have to tell you that, today and now, we are a very litigious society. I think we know that. It's a bit, as I have said before, joking, to demonstrate, should I or not? No. Yeah. We are now a country of 45 million lawyers, right? 45 million. And all of us are constitutional lawyers, right? I think you know where that is coming from. But I think we are very litigious. So yes, the depositors have you could say they have that option to go to court and try and get whatever, right? But the question is, would you sue the one that is protecting you? Would you? If you're a guardian and you have somebody who is protecting you, would you actually go and sue them? Or would you actually work with him to help your situation? You understand what I'm saying? KDSC and CBK are supposed to be acting in the interest of depositors and in the interest of other stakeholders and in the interest of the financial sector. So to actually sue the central bank and KDIC and sort of say, you know, you didn't do the right thing for me, it's kind of curious. By law, look at the CBK Act, look at the KDSC Act. We said we are following the law. And we say that, yeah, every part of it. If there's anything that you think you didn't follow the law, by all means, sue us. But we followed the law. So I think there is an element of just going to court. I don't want to say what may be behind that because it's not my place to speculate. All we can say is that actually for us, it slows us down. And if you recall, we did have this problem in IBL at the beginning. It slowed us down dramatically, actually to a point where we were about to make payments on some disbursements. And the court, for whatever reason, ruled that we shouldn't in particular ways. However, that said, I have to tell you that we are making good progress, even in those cases in court. And I think recently there was a judgment relating to Chase. This wasn't a depositor, this was a creditor. I talked about it last time. So I think the point here is that the role of KDIC and CBK is actually being sort of understood better in this process. And therefore, as you can imagine, a receivership of a bank, we have to understand it is not the same as a receivership of some corporate institution, Nakumat or Uchumi or whatever, where every single creditor is at the same level and all those other things. No, there's a waterfall. Remember, that institution was paying insurance premiums for the depositors. It wasn't doing that for the creditors. There's a waterfall. There's also a serious public interest in terms of depositors. So I think those are the considerations that make banks special. And this is why, in effect, there's no other institution, there's no, in any other, if you think of, for instance, in a corporate world, you don't have an institution such as a KDIC. You understand what I'm saying? That works for creditors. So what you have is a bunch of lawyers that get themselves together and sort of say, let's do what did you call it? Class action suit. I think the class action suit is being done by KDIC. It's the one that is fighting, and CBK, they are the ones that are fighting on behalf of the depositors and stakeholders and so forth. So I hope, Victor, I have clarified those issues. And then finally, there's a question about, may I ask you to withdraw the statement about experts? You mentioned something about experts. Okay, I'm kidding. Yeah, because I think we need to understand. I have a lot of trouble with people who are just banding around policies and so forth. And I really think it's your business to tell them or to call them out on their positions and so forth. What do I mean by that? What you mentioned is that you're worried about the strengthening of the shilling, and you talked about things being better or worse and things like that. I just want to underscore what our policy is with regard to the shilling. I want to make it very clear that not all countries have the same policy as we do in terms of the exchange rate. Our exchange rate policy, to be very clear, we have a flexible exchange rate regime, flexible. So the only thing we do is to minimize the volatility. So we let it move, the exchange rate. We don't have a view as to where the exchange rate should be. We don't have an exchange rate target. But the only thing we do is to minimize the volatility. If it is strengthening very quickly, we will buy US dollars so as to slow the appreciation, right? Not to stop the appreciation, but just to slow it and then let it go. If, on the other hand, it is depreciating very quickly, so quickly is the operative term, then we will sell some US dollars into the market to slow the pace of depreciation. That's basically it. It is quite clear that volatility is quite damaging. This is something that has been well established economically, or that it is quite damaging to the economy and indeed to the markets. And that's why, in effect, it is important to minimize volatility. But in terms of the direction, in terms of a rate target, we don't have that. So what happens is you have the market, the supply of dollars, of foreign currency, and the demand of those by importers and all that. That's where the rate is determined. So, as I said in my presentation, at this moment we've seen it to be very balanced. And there has been moments when indeed you could say that there has been a lot of, for instance, in the last week or so, you've seen it has been strengthening. And a lot of that has been because there's been a lot of inflows. A lot of inflows from some of the exporters, and indeed some of the, let's say, investors that want to benefit from the infrastructure bond that somebody mentioned a moment ago. So you have this inflow of foreign currency, and that pushes up the, I don't want to say up or down because it depends which way you think about these things. DG and I have opposite views of this. But anyway, that strengthens the currency, or has the impact of strengthening the currency, and therefore we buy some US dollars to slow the rate of appreciation. So it's more that. The point is that we are completely wedded to this policy. It has served us well. It has served us well. And I think all of you understand that. You saw what happened during the time when there was a lot more turbulence and we came out more or less even. I'm not talking of the level, I'm just talking of the volatility. It wasn't very volatile. A time when you expected huge volatility. So I think the jury is not out. The jury has determined the case. And the case is strongly in favor of our policy, and we have no business changing that. So anyone else who just comes and tells you models and rates and things like that, please question them appropriately. I think we are good. Beginning with Nicholas's question, alternative models, financing models, and here we are talking, say, public investment projects and so forth, infrastructure projects and so forth. The classic one here is a whole variety of, say, PPPs, right? Private-public partnerships. Now, that is one that is used, but it is not a one-size-fits-all. So there are moments, there are those sort of projects that lend themselves to PPP sort of investment financing model. And they generally tend to be projects that are very clear in terms of costs. Very clear in terms of costs, very few risks in the project. So you wouldn't use, for instance, that sort of financing model to do something rather risky. For instance, I don't know, drilling oil or any of those things, and or even for that matter, investment. Anyway, so the point here is that that is one of several. There are others. I mean, there's the sort of build, own, lease, transfer sort of models. There's a whole variety. The beauty with financing is that you can go, you have the entire range. You can span the set of all the possibilities. And all you need is a few finance engineers, financial engineering sort of gurus. They are not necessarily gurus. They generally tend to be 26-year-olds. And they are very good at what they do. And they will come up with a pretty good outcome for the specific thing. So I think this is really the direction I would want to to lead you. Now, of course, the government has begun doing that. I already gave you one particular example, which is the one of the Mombasa-Nairobi Expressway. You can imagine if that was, it's worth something in the order of 1.4 trillion, I think, US dollars. So you can imagine that if it was all debt. But the engineering point about it is it will be done in sections. It will be sort of an equivalent of a toll road, and by timing things correctly, actually the revenues from the section that is opened will help finance the second, so there's a bit of, and I'm sure all of us have had similar things. You remember if you invest in, most people I've met some people that tell me they want to buy 100 by 50. I don't know whether that is yards, feet, or whatever. And they're going to build they build four flats or four little things. Two they rent, one they stay in, and the other one I don't know what they do. But anyway, it's a model, right? A financing model. So you can see even those 26-year-olds have a brilliant financing model. It's not all, they're not only depending on their salary in order to make the payments, if you understand what I mean. So it's more those sort of considerations. Now, I give you those as examples, but I think one starts there. Price of fuel, the impact of that for the most part has really been, in the past, has really been in the price of electricity. Because we are very dependent, as you know, on hydro electricity. Now we have a lot more, let's say, geothermal and so forth. But in the past, remember, each time we had a drought, the price of electricity would go through the roof. Manufacturers would complain, and it would be very unreliable and so forth. But fortunately, they've been working to reduce that sort of dependency on fuel oil-fired generators and things like that. But yes, you don't use that much electricity for pumping fuel, for pumping water and things like that. This is not, agriculture doesn't go in that direction. But future of agriculture, well, it depends on how much time you have. I'm not much into this in the details, but I think the whole point of agriculture, it needs to be strengthened in particular ways. For instance, most of agriculture is rain-fed. That doesn't mean that we need to just do more irrigation. It means we need to conserve water that much more. We need to be much more water conscious, right? It's a bit like, sorry to put it this way, it's like washing the car. Most of us wash the car by just spraying it with water for like 10 minutes. You waste a lot of water that way. But you could tell somebody, well, you could achieve the same thing having 3 bucketfuls of water to wash the car. You're more efficient and so forth. So the use of water, and then the technology is there. Agriculture is a field that is changing dramatically in terms of the technologies that are there, in terms of the seed. I was talking to a young man, I've talked to you about him before, who actually he's an agronomist, and he has created these tomatoes that are much more hardy, so they can travel without being, squashed or bruised or whatever else it is. So there's a lot of potential here in agriculture, a lot of potential. So we shouldn't look at agriculture in the old-fashioned way, which is if you cannot make it anywhere, well, there's always agriculture as a sort of a fallback option, safety net. Oh, no. This young man, the one that I mentioned before, you can see that he'll go places. Look at all the flowers, for instance. To me, agriculture has a lot of potential. We could look at it in the correct way, not as a sort of a residue of everything else that holds labor, that holds the failures of the world, that holds all the evils of, whatever it is, No. I think there is a lot more going on in agriculture. Okay, the others I think would be, actually there's a question that I think you had asked me to talk about and I missed, so it's in my notes here. And this is the whole business of interoperability, which relates to some of the things that some of you had asked Wallace. interoperability of the various, let's say, money, MNOs, networks. What is behind it? I mean, just to understand, so that we are on the same page. Today now, you have, you're in a particular network, and it probably has sort of a, you can transfer money, you can have money in your wallet, as it were, right? And you can pass it on, you can buy things, and so forth. But when you want to pass money to somebody else, to transfer money to somebody else in another network, it gets complicated. So, for instance, I'm paying you the 1,000 shillings that I owe you, and you're in a different network. What you'll do is you'll get this voucher. It's not printed, but it is an electronic voucher of a kind. And then you'll have to walk around to figure out where my agent is, right? And then you'll get your cash. And then let's say you want to send that money or some money that you have to your mother, who happens to be on my network. So you will then send her the money, or you'll go to your own network provider, your own agent. You will deposit it in your account or in your wallet. Then you'll send money to your mother, who is on my network, and she'll then get a voucher. She'll then go hunt around for your network agent and then get the money. You can see it's kind of messy. I think we understand that issue. The point is, it's not that this was not obvious as a problem. It was always obvious from day one. But I need to wind down, I need to wind back to where we started. This, in my view, is the burden of leadership. When we started off, and this is the whole point, of M-Pesa and all those other things. When we started off, there were no other networks to connect with, right? So in a sense, we were writing the book about this. And in that sense, the issue of interoperability was a non-issue. You only have one, so the issue of interoperability doesn't make sense. Now that you have more, it makes sense. Now, we in the central bank obviously have been trying to see how to improve this. Now, we couldn't probably just say, okay, let's create something in-house or that we can come up with, but we didn't do it that way. Actually, what we've done is we know that other jurisdictions that came after us, Tanzania in particular and others, there are a whole variety of them, have actually been started off in a sort of a positive way, having all this interoperability as part of the package. And we looked at how they do it. There are many models. Let's say behind the scenes, what happens, how do you support it, and so forth. And this is really what we were doing, figuring out what is the best sort of behind the scenes operation to make sure that this happens, that if I'm sending you money, you don't get the voucher, it comes directly to your wallet, even though we're in different networks and things like that. So in effect, this is what we've been doing. We did that obviously with the MNOs, and we have now launched a pilot where they'll then try and see if this works. If you can understand that central banks or regulators in general tend to be rather careful. We don't just rush into things. So we want to be sure that this works. We want to be sure that the risks are mitigated in particular ways. But I think at the end of the day, the objective is to make sure that the customer gets the most benefit. So I just wanted to make it very clear that there has been progress, and I think with time you'll see that being rolled out and so forth. I guess that is an issue I had missed in my list, but I have other issues. Alex was asking about whether 6.2 is too optimistic. Actually, I'll put it a little different. 6.2 is a baseline, and there are risks of this baseline. So you have, let's say, upside potential, and I talked about some of the upsides, right? You also have downside risks, like all this, the ones you mentioned, right? The interest rate caps is part of the baseline. That we know, it's there already. But insecurity and all these other things, that's all on the downside risks to this. I mean, we could also have another drought, right? I mean, all these things can happen. But I think the point there is, do we have the mitigating factors in place? And I think the question is, if we had another 2017, how could we deal with it? I'm talking of, for instance, in agriculture, right? I mean, do we have enough reserves to buy food? Do we have, those are the considerations that we have. And my point on my presentation was saying that, the bottom line of it is, yes, actually we are in a pretty strong position. And actually what we see more of is the upside risk, which we haven't incorporated in the 6.2. So in a sense, let's get positively surprised. Or maybe after we've incorporated what is being done, and in particular the policy, the positive supporting policies that I mentioned, then we can really get somewhere in terms of make a projection that makes sense. We are not into, at least the central bank is not into this business of making projections as, to make a statement. We stand by our projections, and we explain what is in it, and also explain what is not in it. And if those things come to the fore, then we revise our projections appropriately. Trickle-down benefits of the economy. This is a very complicated question. I would ask you, do you have like a week that we can discuss this? Because really this is the issue of how, the general point, you do not eat GDP, right? That's the general point you're making. But I think the point here is it's more than that. And it's not just the incomes. So this speaks to, for instance, what are the sectors that are growing, and what are the inputs in case, for instance, labor, right? You could think of mining, for instance. The mining sector doesn't pick up too much labor. It's not that labor intensive. Now, agriculture tends to be thoroughly labor intensive, at least the way we do it. But I think the point here is that it also happens to be low wages, so productivity is very low. So there's a lot of discussion about improving productivity. For instance, the young man I talked about, you can see he's very productive. His productivity is probably higher than most of us in this room, if you want to put it that way, even though he's in agriculture. So there's a whole set of questions. But my favorite, most important in this is this all leads to what you could call the inequalities, right? So in that, now I was talking about inequalities of income. But the biggest inequality of all, and this is a worldwide phenomenon, is actually the inequality with regard to opportunities. Inequalities with regard to opportunities. And it often starts very early. So think about the quality of education in the little primary school. You saw pictures, you published some of these pictures in the newspapers. Some schools that, quite interesting in many ways, right? Actually, even their own teachers. Actually, one of the teachers and an AP police officer got a prize, a presidential commendation, having crossed rivers to go to supervise an exam, right? You remember that whole thing. So health is another one. Inequalities with regard to health. And this is why the whole issue of universal health is so important. A certain minimum quality of health that all of us can. So I just want to say that if you had a week, and I had a week, we could probably spend a lot of time on this, but so it's a good question nevertheless. We go back then to the final questions about what we mean by accommodative monetary policy, headlines question. I think the only point I would make here is that, the point again is that we want to provide more credit, right? That's the way we think of it. So we want to have a set of policies to provide more credit into the economy. It is true the credit, as you mentioned later, credit growth is beginning to pick up, and also other considerations. But I think the point here is, and now I'm going to more your last question. The issue here is a counterfactual. Yes, 2017, as we said, showed remarkable resilience. That's what I mentioned. But the remarkable resilience was built on particular, let's say, underpinnings. So the question would be, if we didn't have all that, let's say, headwinds, all those headwinds that you are talking about, where would we be? That is the question I think you're asking. And that is, I mean, you can guess as much as I would. Definitely to be much higher. So I think the point here is that even in the face of all these headwinds, we ended up around 5%. And even if you call it 4.8 or 4.9, that's around 5%, which in the circumstances is pretty good. And I think that's really the concern that we have. We are not going to sort of, let's say, we do not want to stay where we are forever. And in a sense, given the question that was asked also, I mean, we have an obligation to the rest of the population, those that are not I mean, those that depend on us and depend on our policies. So I think there is a strong obligation for us to get the most, to make the most while the sun shines. Last question was about interbank market. We are fixing it. We haven't fixed it, meaning we haven't fully fixed it. The interbank market still displays unusual segmentation, and liquidity management remains a key issue. But we are making progress there. There are many things we've done and more that we will do. But at this point, I can just say that hasn't finished. It's true we've been on this journey for quite some time. But I think at times it helps if we are a bit more patient. And one thing the central bank doesn't have is much patience. But in this, we've been very patient. I don't want to agree with you, Headline. I don't want to say that that's what they had in mind. It's not testing. I don't think the issue is to test. The issue is, what is the outcome that you want? The outcome that they want is to have a much more accommodative monetary policy, meaning provide more credit to the economy, meaning provide more dynamism in the economy. And the question is how to do that. And what they believe is that by giving forward guidance in this way, it will allow them to have, it will enhance the likelihood, let's say, it will increase the likelihood of a non-perverse reaction. The next sentence was one in the press release was one of monitoring and observing the situation. That's really what it is about, meaning they are not just monitoring, they want to be sure that if any action is done, we know which direction it will go. So, and there's more than just monitoring numbers, there's monitoring anyway. So I hope I've answered your question. Then Mombi had a question about blockchain and so forth. I think I've made this point before. I will say three things really. First, I've been quite clear about our views on Bitcoin and the Bitcoin-like items. So that I don't want to repeat. It's quite clear that from our perspective, that is something that we cannot support. And if you want to invest in those things, well, it's a bubble of a kind. And be ready to lose all your money in that whole operation. And indeed, if there are concerns, there are other concerns. But I think we have kind of, particularly our Novorish, in Kenya, been so excited about the Bitcoin thing, and they're putting their money there. It's dangerous because people may put in all their money, and then in the end you'll have a serious issue in particular ways. I don't want to bring comparisons and so forth, but at the same time, I have to tell you that we are not doing this alone as a central bank. We are doing this with our peers around the world. DG has been participating in discussions around the world. She represented us in Washington, D.C. Recently on discussions about this. I also have been in various places on this. I'll be speaking, I think, later this week on some of these issues. So the point I'm making is we are not doing it by ourselves. The idea that the central bank has been sitting on the side of the road and only now we're being woken up because somebody has said Bitcoin doesn't ring true. So let me leave the Bitcoin out of the picture. Is that okay? Then the other things, I said there are three. So the other things are blockchain. We've made the point that blockchain, the technology itself, is something that could be useful and has potential to be useful. We are not Luddites. We are not anti-technology. I've made this point before. On the contrary, the issue here is to make sure that, and actually last time I think I gave you the example of even the technology about nuclear energy. I mean, in itself, it's a pretty good technology, and it has been used. We've managed to use it in particular ways, even curing cancer, even electricity, all these many things. But of course, you have risks. You have risks because you could get somebody walking around with a nuclear thing in his backpack, right? You don't want that to happen. But the point I'm making is the technology itself, of course, it can be used in particular ways. The point now is to use it. And here is where I would want to make the point that, there are two levels, right? And I made this point, I think, last time. You do have the creators of technology, right? And then you have the innovators, that change the technology and make it work. I don't know if you understand. There are two levels. All of us want to be Steve Jobs, who happen to be at both levels at once. No, most of us are either at one level. Quite often we are, one of the two. Let me not say where we generally are, right? So it has to be applicable. We meet on a regular basis some of your fintech colleagues. And when they talk to us at times, they tell us, oh yeah, I've created this new thing, it does this. And you ask them, okay, what language have you used to code? I'm not going to tell you what they tell us, which is some of them there's a language is very easy to code, but it's so easy to hack. You understand? Then the thing is of no use to man or beast. The point here is that there are other considerations in making something useful. And there has to be a specific, let's say, objective or outcome, right? A specific problem that is being solved. And also it has to be done in a way that is consistent with the risks that we see and all those other things. So that is not a problem for blockchain. That's a problem of the innovators themselves. They have to be more positive and understand that we are working here on the world. We are not in Mars. We are not in some utopic island or any of those things. We have certain concerns. We need to have those addressed. And indeed, all the risks need to be dealt with appropriately. I'm sure I've answered your question thoroughly.